Hello, everyone, and welcome to The Buck Stops Here. I'm Catherine Murray. Well, as we know, as you look at the markets, there's been a lot of volatility, a lot of uncertainty, so many unknowns and various factors affecting the markets on a day-to-day basis, minute by minute. So I'm very thrilled to bring you our guest today, Myles Zyblock. He's the Chief Investment Officer at 1832 Asset Management, which encompasses the dynamic funds. Myles, welcome. There's just so much to discuss today to figure out where we're going next. Thanks for being with us.
It's a pleasure to be here. Thanks for having me on, Catherine.
Thank you. I've read a lot of your recent research reports, and one of the titles that stood out to me was, it's complicated times, or it's complicated. There is a lot to discuss in terms of the diverging central bank policies that are out there around the world. Also, of course, earnings, the Ukraine-Russia war. From a top-down macro perspective, where do you think we should start in terms of the key driver that you're thinking about today?
Where should we start? There's so many things going on, like you said. I think, if you were really trying to summarize the world and what's going on, you have, I guess, three big macro issues. One is growth, and where might that be heading? Global economic growth. The second is inflation, and the third is central bank policy. So, and I think all of those three big macro themes are very interrelated. We're concerned about growth. We're concerned about inflation. And yet, the central banks still seem very, very set on tightening policy settings pretty much everywhere around the world, except for a few countries like in Asia.
Right, which I find interesting, just for a second here, that, you've got China and Japan, some of the world's largest economies that are actually more on the easing side versus the United States, UK, Canada, as an example.
Yeah, I mean, that's absolutely true. I mean, we've all read about the issues, the lockdowns that are going on with respect to COVID in China. So large swaths of the Chinese economy have been locked down. People are in their houses and aren't really allowed to leave. And that's obviously affecting economic activity in China. There's some estimates out there that something like 300 million or a little over 300 million people are in lockdown. The areas or the locations represent close to 40% of Chinese GDP. So that's they're obviously under a lot of economic stress right now, and their policymakers are in no mood to tighten policy settings. In fact, there has been some easing in China. Now, you move over to Japan, the Japanese policymakers, I mean, they've been looking for years, if not decades, for somewhat higher inflation. And they're the only country probably on the planet that's really hoping for some inflation. And they're still kind of stuck at a 1% inflation rate. They're still below their 2% inflation target. And they just don't seem in any mood to tighten policy settings. In fact, they've said that, the inflation that they're experiencing is out of their control. It's to do with energy and food. So why bother tightening? That's not going to fix the issue. So, those are two major economies that seem to be very comfortable, with the inflation backdrop. Whereas, as you mentioned, the rest of the world, whether it's the UK, even Europe, continental Europe, the US, Canada, they're all seeming to want to tighten policy settings for sure. So there is a policy divergence that's opening up in the world.
Which is interesting because we really haven't had that, I don't think, since the financial crisis. And so now you've got these central bankers really weighing the inflation risks versus the growth risks. And I really wonder, what the right policy is going to be in terms of the implications and the potential for kicking off a recession in the United States.
That's the $1 million question, right? They're walking a tightrope right now, in the sense that, how much weight are they putting towards a growth outlook versus the inflation outlook? If they're going to continue to focus, and I'll give you an example here with Europe, if they're going to continue to focus very much more on the inflation outlook than the growth outlook, they're going to bury the economy. I mean, Europe's already teetering. I mean, it's got some trade issues. It's got, especially because of their close links to China, they've got some trade issues in continental Europe. And they have surging fuel costs. They're large importers of fuel, so that's taxing obviously the consumer and businesses in Europe. And yet they're still set. The ECB, the European Central Bank, just recently said that they're going to raise rates. And so that's the U.S. is in a little bit better position though, and perhaps we can get more in depth on that.
Yeah, we'll pick it up right after the break. Myles, just to pick it up on the last point, which is, it seems as though, Europe has its own set of issues for sure. But when you move over to North America, it does appear that the United States economy is still quite strong despite the contracting GDP figure we saw this week. And therefore, of course, we can have different central bank policies in the United States and likely Canada as well because of our strong commodity business. But how does that play out in your mind? And how do you see the U.S. economy right now and what we might see going forward?
So the U.S. economy is already, first of all, I think it's still in okay shape. Despite the fact that we saw a negative GDP print, that's a little bit technical. The point is that, private sector investment and private sector in consumption are still very strong. And that's about 88% of the U.S. economy. What you saw in that latest GDP report where you saw, a drop in GDP of about 1.4%, that was entirely due to trade. And I don't think that's going to be sustainable. So if you just look through the numbers and you say, well, how's the organic health of the U.S. economy? It's still okay. Now, I'm not saying there isn't slowing. I mean, you're seeing it in housing, you're seeing it in trucking, you're seeing it in certain areas of the economy where, the interest rate increases already are having somewhat of an impact. But I don't think this is going to deter the Fed. The Fed still sees very, very strong labor markets. It still sees very low unemployment rates. It still sees, I think the risk of further upward pressure on wages. So I think the Fed's going to continue to tighten policy. And I could say the same about the Bank of Canada. And if you just look at what fixed income markets are expecting for the remainder of the year, I mean, they've got the Fed raising rates another 200 to 250 basis points, or 2.5%. And in Canada, it's similar. It's 200 basis points. So, the markets are pretty convinced that both the Fed and the Bank of Canada are going to be tightening policy settings for much of the remainder of this year.
And you seem to believe that they will absolutely do that. I guess the question, though, is, are they going to make a policy mistake? And you do point out, of course, that in most tightening cycles, they actually do make a policy mistake and cause a recession.
So it's too early to say that right now. I'd say that, the next 50, 75 basis points probably will not be a mistake. When you think about mistakes historically, they typically get flagged by the inversion of the yield curve, and in particular, the spread between the 10-year Treasury yield and the 3-month T-bill rate. And there's still a big spread there. So I'm not sure that, the next 50 to 75 is going to be a mistake. But, as we get later into this tightening cycle, we have to be, much more sensitive to what the central banks are doing. And, that's not to say that the markets aren't feeling some indigestion from this tightening cycle. Let me just say that. I mean, we know that, equity markets have been struggling, bond markets have been struggling. And in fact, if the year closed out right now, both the 10-year Treasury would have a negative total return, and the S&P would have a negative total return. I look back to 1970, and that's never happened before.
Really?
Yeah, never. No, not since 1970, when both the 10-year Treasury yield and the S&P were down on the year.
So what does that mean? And maybe
it's tough, Catherine.
What's that?
It means it's tough. It means it's really tough out there. Yeah.
Well, it's interesting as well, just, taking a look at the first quarter earnings results, and you point out that the overall growth is, 6-point-something% so far. But that if you X out commodities, I think it's 1%. It's not a lot of growth, and that most of the sectors are actually down. Yeah,
I mean, look, relative to expectations, companies are doing fine, but I think it's something like 75% of companies in this quarter's reporting season in the U.S. have put up numbers that are a little better than expectations. But the aggregate growth rate is not great. Now you're coming off the prior quarter, which was huge in terms of earnings growth. So you're getting a little bit of base effects here. But yeah, for sure, earnings growth is slowing, and it's slowing meaningfully, just like the economies are slowing meaningfully. And let's just be. I think that's part of the indigestion problem, where we're sort of ratcheting down our growth expectations, and that's weighing on PE multiples, as are rising interest rates. And so that's what's causing a lot of the problem, or a lot of the volatility in the markets. But I don't think we're heading into earnings recession. I don't think we're heading into economic recession right now. Talk to me in 5 or 6 months, and we'll revisit that thought. But for now, I think this is all about, changing our growth expectations, resetting our expectations to something that's more realistic. And again, in doing so, we're creating some volatility in markets.
Absolutely. All right, we're going to pick it up right after the break. Myles, I want to pick it up on, and I want to get for our viewers, your thoughts in terms of where to invest and safe haven trades, if there are. I mean, we talked about it being very difficult in terms of the investment climate. But I first want to ask you, many strategists and economists will say that, a recession is inevitable. But we've had recessions in the past that, maybe were short-lived, didn't infiltrate the entire economy. But there have been historically, many years where the recession, was just so broad-based. What do you think a recession would look like if and when we get one?
I think it depends on your country, Catherine.
Okay.
If you're talking about the US, so I worry about Canada. As we all know, household balance sheets are incredibly leveraged in Canada. The last time I looked was only about a week ago, and debt to disposable income for Canadian households hit a new record, an all-time new record. So we're a leveraged country. Our consumers are heavily leveraged, and I think that ultimately, if you're talking about recession here, it's because central banks are tightening interest rates, and housing is the most interest-sensitive sector in the economy, or one of the most interest-sensitive sectors in the economy. So I think a recession here could have a little different flavor than, say, in the US, where household balance sheets have definitely been delevered over the last 10 to 12 years, 15 years, where they're looking in pretty good shape, the consumer. And so I think the recession would probably be a little more broad-based and deeper in Canada if that were to occur.
Interesting. So what sectors then, if we think for the next at least 5 months, and then going out a little bit further, where do you see at least some protection, or how are you advising your clients to invest and protect portfolios?
Yeah, so historically, when you look, the context of this, the magnitudes are always different, but the context or the dynamics inside the markets are very similar to what we've seen in past cycles, where you've seen growth begin to slow. In large part, people have moved, and this is kind of what we've been advising. People have moved towards dividend growth, companies with more reliable profitability streams, so more stable growing companies. So stability, income, those are at the top of the list. And a lot of the sectors that you expect are the usuals, like consumer staples, a lot of the healthcare sectors, utilities, and those are where you usually find better relative performance in environments where people get concerned about growth and there's actual visible signs that growth is slowing. And I guess the outlier in this cycle so far has been the energy sector, where I wouldn't call those companies generally the most stable growing companies, but yet they've caught a very healthy bid. They're one of the leading sectors over the last 6, 9, 12 months. And so there's a little bit of a difference going on there than in the past. I'm not saying that we have taken a slight overweight position in energy. But energy, you got to live with the volatility. That's the issue with energy. I mean, point to point, you say it's up, 40, 50%, these stocks, but to get there, you've had to hang on to some wild rides. So sometimes that's very hard for people to stomach, right? But
Yeah.
but energy is sort of the outlier in terms of going for stable growth, and then you have this sort of barbelled with energy, and energy is had a lot of things going right. You've had underinvestment for years. You've had synchronized global growth, which now is slowing, so you have to be careful about that. And you've had obviously the geopolitics that have played into the energy sector, which have kept it propped up. So look, I think for the lion's share of most portfolios, you're thinking about high quality companies, solid balance sheets, not worried that much about interest rate risk, and stable earnings delivery.
Okay. I'm also curious as well in terms of outside the North American markets. Germany, for one, from a PE perspective, looks very attractive. But of course, we've got to consider the implications of the Ukraine-Russia war, relationships with China on the trading front. We'll take a quick break. When we come back, we'll pick it up on that note. So, Myles, we've heard your approach as we think about the North American equity markets and where to have exposure and the right positioning. What about outside of North America in terms of opportunities? Is Germany an opportunity right now?
Germany, on the surface, looks like a great opportunity. Germany has, one of the lowest PE multiples of the developed world. I think it's trading somewhere around 11 times earnings. And you compare that against pretty much, particularly the US, and you go, wow, what a steal. But I think part of the issue when it comes to Germany and Europe proper, continental Europe, the Eurozone, is that I think the valuation metrics are a little bit flattered by too much optimism in the earnings outlook. So it's the E part. Where I think people have maybe those earnings expectations are too high. I do think, if you're talking about recession, I do think there's a very, very high risk of Germany falling into recession over the next 1 or 2 quarters even. I'm not sure how deep it'll be at this point, but, in an earnings recession or in an economic recession, you are going to get an earnings recession most likely. And so that PE multiple will not look as attractive as it appears on the surface. So you have to be somewhat careful. When you're talking, when you're just saying, well, I'm going to buy a market or a stock, whatever it is, just because it looks cheap, there could be reasons why it looks cheap. And I think part of that is because, people are very concerned about not only the near term, but the longer term earnings outlook for Germany, for Europe, et cetera.
Understood. Looks like an opportunity, but might not be. I'm curious as well in terms of alternative investments. I think over the past number of years, and I believe in this, that every individual should at least have the ability to get exposure to alternative assets like hedge funds, direct real estate investing, venture capital, private equity, et cetera. And there are vehicles out there that allow for that. I do have a concern, though, that in a rising rate environment, that will put downward pressure on the valuations, and these companies don't tend to get mark to market like the equity market does. Is there an underlying risk in terms of valuations that we should think about, or in a rising rate environment with all these uncertainties, some of those areas are great places to be invested in?
Well, I think, alternatives, when people talk about alternatives, they think it's this one unique sort of situation, but we know that the alternative investment universe is very broad. It's a very broad spectrum of assets that you can talk about. You can, it can be everything from commodities to various liquid alternative assets to private investments, et cetera. So I think, sort of a broad brush, you can't just stroke this whole thing. Not all things are the same. I mean, when you look inside the alternatives world, what you're trying to, when you're thinking about where I need to be in the alternatives world, you say, what types of assets will give me different performance streams than the traditional asset classes? And I think that's how, when you think about it, whatever that might be. So, absolute return strategies, for example, might be an area because they have historically had very low correlation to the performance of stocks and bonds. And in fact, this year, absolute return strategies are up, a couple percent. And so that would have helped you. But, when you're saying, should I be in alternatives, I'm not sure that's the right approach. It's, what do I own today and what can I get that behaves differently? Because, the more horses you have in this race, the more likely you're going to get one of those horses across the finish line. So you want, let's call it several pistons in the engine that can work. If one misfires, you have others to rely on. So, I don't think you can just look and say that one alternative is better than the other. What I think you have to really do is look at your own portfolio and say, of what I already hold, what is most dissimilar in the alternatives universe that I can include in the portfolio to give me more robustness in terms of performance? And robustness meaning, given, there's a wide range of potential financial market and economic outcomes. So I want something that behaves very differently to stocks and bonds. So again, I don't think it can be as simple as, should I own private equity or not?
Right.
That's my approach to alternatives. Yeah.
No, I appreciate that. I think now more than ever, you have to do your homework. We've had the Fed at our back for a decade, and it really comes down to investment professionals, I think, that have many years of investment experience.
I think that's right. I think as the wind is no longer, it's more in our face than at our back. I think that we have to become a little more careful about what we're putting in our portfolios nowadays. Yes.
Absolutely. Myles, great to be with you today. Thank you so much.
Always great to be here, Catherine. Thank you.
Thank you.